Goldman Sachs. What comes to mind when you hear that name? For a lot of people, it's images of incredible wealth, of unmatched power, and yeah, decades of controversy. This isn't just another bank. For many, it's the very symbol of modern global finance. And we're going to dig into exactly why that is. You've probably heard this quote before. It's maybe the most famous description of Goldman Sachs ever written. Right after the 2008 financial crisis, this one brutal image from Rolling Stone writer Matt Taibbi just cemented a public perception of the bank that has stuck for over a decade. But is it fair? Is it the whole story? I mean, that's the real question, isn't it? How did one firm go from such a humble start to becoming this global behemoth, praised by some as an architect of capitalism and condemned by others as its greatest villain? So, that's what we're here to do, to break it all down. To really get a handle on the Goldman of today, we have to start with its modern reputation. Because honestly, depending on who you ask, you are going to get two completely different stories. And this is where things start to get really complex. I mean, just look at this list. It really lays out the two faces of Goldman Sachs, right? On one hand, you've got this global financial powerhouse, an innovator that literally helped build modern capitalism. But on the other, it's seen as the ultimate symbol of corporate greed, a firm so connected to government that people call it Government Sachs. So how can both of these things be true at the same time? All right, so how did we even get here? To understand the giant, we have to go way, way back to the very beginning. And you might be surprised to hear it's a pretty humble origin story. You're not going to believe this, but it all started in 1869. A guy named Marcus Goldman opens a tiny one-room office in a basement right next to a coal chute. But from that tiny start, the firm grew like crazy. It pioneered what we now call the modern IPO, the initial public offering. That's how companies sell shares to the public for the first time. And they did it for massive companies like Sears. But that same ambition, it led to their first huge disaster, a fund that completely imploded in the 1929 crash, nearly taking the whole firm down with it. This was an absolute make or break moment. After the total humiliation of 1929, a new leader, Sidney Weinberg, saw that the firm's reputation was in tatters. He made this absolutely crucial decision: shift the focus away from risky trading and toward the more stable, client-focused world of investment banking. And that pivot, it arguably saved the entire company. And that one decision totally set the stage for what a lot of people call Goldman's golden age. This was a period of explosive growth where it really defined its culture and cemented its place at the very top of Wall Street. Long-term greedy. I mean, what a phrase, right? It sounds a little sketchy, but what the partner, Gus Levy, really meant was that it's okay to take a smaller profit or maybe even a loss today if it helps build a relationship that's going to pay off for decades to come. It was all about prioritizing the long game over the quick buck. And wow, did this strategy pay off. This slide just gives you a taste of how dominant they became. Goldman was right at the center of some of the biggest deals of the 20th century. They managed the massive IPO for Ford Motor Company, they invented new strategies to defend companies from takeovers, and in 1986, they took a little company you might have heard of, Microsoft, public. They weren't just playing the game anymore. They were basically writing the rulebook. Just look at this tower. Seriously. When you put this gleaming headquarters in Manhattan next to that image of a one-room basement office from 1869, well, you really get a sense of the incredible journey. But as the firm got bigger and bigger, that old philosophy of being long-term greedy started to clash with an immense pressure to generate huge short-term profits. And that pressure, it all came to a head in the moment that changed absolutely everything: the 2008 financial crisis. This is where that vampire squid image was born and where the firm's reputation was altered forever. Okay, to really get what happened, we have to talk about something with a super boring name: a synthetic CDO. It sounds complicated, I know, but here's the simple version. Just imagine a giant package, and it's filled with thousands and thousands of home mortgages. The CDO was basically a way for investors to bet on whether the people who owned those homes would pay their mortgages or not. You could bet they'd succeed, or you could bet they'd fail. And right here, this is the core of the controversy. Goldman Sachs saw the writing on the wall. They started to secretly bet against the housing market to protect themselves. But at the exact same time, they were selling investment products based on those very same mortgages to their clients, who were all betting the market would go up. It was a massive, massive conflict of interest. So you might be wondering, how did that bet against the housing market turn out for them? Well, in 2007 alone, as the world economy was literally teetering on the brink of collapse, Goldman made a reported $4 billion from the crash. But here is the most incredible, almost unbelievable part. Even after making billions betting on the crash, the global crisis was so severe that Goldman was still considered too big to fail. So in 2008, the U.S. government gave them a $10 billion bailout. Naturally, the public was furious. The fallout was just immense. In 2010, the firm paid a $550 million fine from misleading investors. But, and this is the part that drives people crazy, as part of that deal, Goldman never had to actually admit they did anything wrong. So this whole chapter of the story, it really opens up the final piece of the puzzle, the firm's extraordinary and very controversial relationship with the government, which, as I mentioned, has earned it that nickname, Goldman Sachs. This relationship is so close, so intertwined, that it's often described as a revolving door. You see high-ranking Goldman executives leave the firm to take powerful government jobs, and then sometimes you see government officials leave public service to go work for Goldman. And when we say revolving door, we're not talking about a few mid-level people. The list of alumni is just staggering. I mean, think about this. 3 of the most recent U.S. Treasury secretaries, the people in charge of the entire American economy, came directly from Goldman Sachs. The same goes for top White House economic advisors, even the heads of major European central banks. It begs the question, right? When former bankers are in charge of regulating the banks, whose interests are really being served? And don't think for a second that the controversies just stopped in 2008. As you can see here, in just the last few years, the firm has paid out billions for its role in a massive corruption scandal in Malaysia, hundreds of millions to settle a gender bias lawsuit, and tens of millions for other violations. For a company like this, you have to wonder if these massive fines have just become, the cost of doing business. Which brings us all the way back to the beginning. From a basement office to a global powerhouse that shapes markets and influences governments, Goldman Sachs is clearly more than just a bank. But when a single firm becomes this powerful, this complex, and this deeply embedded in the very systems that run our world, it forces us to ask a really tough question. What does accountability even look like?